The VA Home Loan Program is a truly valuable resource for our veterans, offering incredible opportunities for home ownership.
Absolutely. It's a fantastic benefit.
But if you've ever glanced at the details, you might have noticed that understanding the various fees involved can feel a little like, well, navigating a maze.
It really can seem that way sometimes. There are quite a few rules.
That's precisely what we're setting out to clarify for you today.
Yeah, we're taking a deep dive into the borrower fees and charges associated with the VA Home Loan Program.
And we're using the best source, right?
Right. Our guide for this exploration is the VA Lender's Handbook itself, so we're getting the definitive information straight from the VA.
Think of this as your shortcut to understanding these costs. We're going to break down exactly what fees veterans can pay.
And maybe more importantly, what they are absolutely protected from paying. That's key.
Definitely. We'll also look at how other parties, like sellers, can play a role.
And what happens to these fees if a loan doesn't actually reach closing?
Good question. We'll cover that. Plus, which fees can actually be incorporated into the loan itself.
And of course, we'll be taking a comprehensive look at that crucial VA funding fee. Lots to unpack there.
For sure. Our goal is that by the end of this discussion, you'll have a clear and confident grasp of the rules governing VA loan fees.
We want to empower you with the knowledge to navigate this part of the home buying or refinancing journey with, ease and understanding.
Okay, let's get started by looking at the big picture. What are the fees that veterans can actually pay as part of a VA home loan?
Well, the fundamental principle here is really to safeguard the veteran's benefit.
Right.
VA policy intentionally limits the fees they can be charged. It's all about ensuring affordability and preventing undue financial burden.
Makes sense. So how is it structured?
Generally, there are three main categories of fees a veteran might encounter.
Okay, what are those categories?
First, there are what are termed itemized fees and charges, and these must be reasonable and customary for the area.
Itemized fees and charges. Got it. What's number two?
Second, the lender can charge a single flat fee, and that's capped at 1% of the loan amount, usually.
1% flat charge.
Okay.
And the third?
And third, veterans can choose to pay reasonable discount points, typically to get a lower interest rate.
Right, buying down the rate. Okay, let's unpack those itemized fees and charges a bit more. Our source, the handbook, gives specific examples.
It does.
What are some of the key ones you should be aware of?
Certainly. Okay, so when it comes to appraisals and compliance inspections, the veteran is typically responsible for the cost of their own appraisal.
Their initial one.
Yeah, their initial one. And any necessary inspections to make sure the property meets VA standards.
Okay.
What's interesting to note is that if a veteran disagrees with that initial appraisal and requests a second one, maybe to reconsider the value, they can also pay for that second appraisal.
But there are situations where a veteran isn't responsible for appraisal costs, right?
Exactly. That's crucial. Veterans cannot be charged for appraisals that are requested by the lender or the seller if they're the ones seeking a reevaluation.
Okay, so if the lender wants it, the lender pays.
Right, or the seller. Similarly, if an appraisal is initiated by some other party who isn't the veteran or the lender, the veteran isn't obligated to cover that cost either.
That makes sense, yeah. It depends on who's asking for it. What other types of fees fall under this itemized category?
Okay, so you'll see recording fees. That's just the cost associated with officially documenting the loan with the county or local government.
Standard stuff.
Pretty standard. Then there's the fee for the lender to get your credit report.
Right.
Interestingly, for loans processed through the VA's automated underwriting system, there's sometimes a flat $50 evaluation fee that can be paid instead of the usual credit report charge.
Okay.
And if the system flags the loan as a refer case, meaning it needs more manual review, there might also be a charge for a merged credit report from multiple bureaus.
Gotcha. What else?
You'll also encounter prepaid items, things like the prorated portion of property taxes and assessments due for the current year, and also the initial deposits that go into your escrow account for future property taxes and homeowners insurance.
So these are generally the standard upfront costs associated with buying a home, really.
Pretty much. Standard closing costs.
What about insurance itself?
Yes. The premium for your required hazard insurance, homeowners insurance that's payable by the veteran.
And flood insurance.
That too. If the property property is located in a designated flood zone, that premium is also a fee the veteran can pay.
Okay.
And speaking of flood zones, there's also the cost of a flood zone determination.
How does that work?
This can be charged if it's done by an independent third-party company that actually guarantees the accuracy of their findings.
Ah, okay. Not just anyone.
Right. Or you can pay for a life-of-the-loan flood determination service right at the beginning. But importantly, lenders or VA appraisers cannot charge a separate fee for doing this determination themselves.
Got it. What about things like property surveys and title-related expenses?
A survey can be charged to the veteran if it's required by the lender or if the veteran personally wants one.
Makes sense.
Though for condominium purchases, VA approval is needed to charge the veteran for the survey fee.
Okay, little wrinkle for condos. And title.
For title work, yes, the veteran can pay for both the title examination, that's the research into the property's history, and the cost of title insurance, which protects everyone against potential title problems down the road.
Right, very important.
And if the lender decides an environmental protection endorsement is necessary for that title policy, the cost of that specific endorsement can also be passed on to the veteran.
Are there any specific itemized fees that might pop up mainly for refinancing a VA loan?
Yes, good point. For refinancing loans, there is a provision for special mailing fees, like for FedEx or UPS. Well, it's only allowed if the interest you save per day by getting the loan documents faster is actually more than the cost of the express mail service.
Ah, so it has to make financial sense.
Exactly.
Yeah.
It has to save the veteran money overall. And, of course, unless you qualify for an exemption, the VA funding fee itself is an itemized fee you'll pay.
We will definitely be digging much deeper into the funding fee later. What else is on this list of itemized fees?
Okay, there's the Mortgage Electronic Registration System, or MERS fee.
MERS.
Yeah, it covers the electronic tracking of the loan's ownership as it gets potentially bought and sold on the secondary mortgage market.
Oh, okay.
And finally, there's a sort of catch-all category for other fees authorized by VA.
What falls in there?
These are less common. They'd be specific fees approved by the VA's Regional Loan Center for a particular area, and they must be considered customary for borrowers in that specific place.
So a pretty extensive list of potential itemized fees. Are there any, overarching rules for how these are charged?
Absolutely. Two really key principles to keep in mind here.
First, for any service performed by an outside company, like that credit report we talked about, the veteran can only be charged the actual cost the lender paid. No markups allowed.
So if the lender pays $30, they charge $30.
Exactly. Not $35, not $40, just the actual cost.
Good protection. What's the second principle?
Second, there's a firm rule against charging duplicate fees. If a service has already been done and paid for, you can't be charged for it again on the same transaction.
Can you give us a practical example of that? Like, how would that play out?
Sure. Let's say a previous buyer had an appraisal done on a house, but their deal fell through.
Okay.
Now you, a veteran, come along and want to buy that same house with a VA loan. If the lender can use the existing still valid notice of value from that prior appraisal, they cannot charge you for a completely new appraisal if one wasn't actually needed.
Because the value is already established and valid?
Exactly. The same idea applies to things like property surveys or flood determinations. If a valid one already exists and the lender uses it, the veteran shouldn't be charged for a new one.
That seems like solid common sense protection for the borrower.
Yeah.
Okay. Now, you also mentioned that lenders can charge a 1% flat fee. What's the purpose of that?
Right. This 1% flat charge is a really crucial piece of the puzzle. It's designed to cover basically all of the lender's administrative costs and services that aren't specifically reimbursed through those itemized fees we just went through.
So it's like their overhead cost.
Pretty much. Think of it as a way to streamline the lender's compensation for their general overhead, the work involved in originating the loan, processing the paperwork, all that stuff.
Okay.
Interestingly, this 1% fee is calculated on the total principal loan amount after the VA funding fee has been added, if the funding fee is being financed.
Oh, so it's on the slightly higher amount if the funding fee is rolled in.
Usually, yes. The notable exception here is for IRRLs, those interest rate reduction refinancing loans, which have their own specific worksheet for calculating this fee.
Got it. So what exactly is this 1% flat fee intended to cover? What services and costs are bundled into that charge?
This is where it's really important for you to understand what you shouldn't be charged for separately.
Right.
The lender's 1% flat fee must cover a pretty significant range of items. These cannot be charged to the veteran as additional itemized fees on top of the flat charge.
Such as?
Okay, it includes the lender's own costs for appraisals they might order, most inspections the lender might require.
Wait, I thought the veteran paid for the appraisal.
The veteran pays for their appraisal, the main one needed for the loan. But if the lender decides they need another appraisal for their own internal reasons, that cost is covered by the flat fee.
Ah, okay. Distinction there. What else?
It also includes things like closing or settlement fees charged by the lender, the cost of preparing the loan documents themselves, any attorney's services provided by the lender's attorney.
But not title work, you said.
Correct. Title examination and title insurance are separate, allowable itemized fees. This is just for the lender's own legal counsel related to the loan processing.
Okay. Keep going. What else is in that 1%?
Other costs covered. Photographs of the property if the lender needs them, fees for locking in your interest rate, general office expenses like postage, stationery, phone calls.
Wow, pretty granular.
Yeah, also the creation of amortization schedules, any membership or entrance fees the lender might incur, escrow fees or closing fees charged by the lender or their agent, notary fees.
Okay.
Dot commitment or marketing fees related to selling the loan later on, trustees' fees, loan application and processing fees, preparing your truth in lending disclosure.
So, like basic loan processing charges.
Exactly. Fees paid to any loan brokers or finders, whether they're affiliated with the lender or not, and even fees for tax servicing during the life of the loan. It's a very comprehensive list.
Yeah, that really clarifies what that flat fee is for.
Yeah.
So if a lender tries to charge you separately for something like document preparation or loan processing,
That would likely be an inappropriate double charge, yeah. Those types of costs are specifically meant to be covered by that 1% flat lender fee.
good to know. Now, you mentioned earlier that construction loans have some different rules regarding this flat charge. Could you explain those differences?
Yes, absolutely, because construction loans typically involve, well, more work and oversight for the lender.
Makes sense, watching the building process.
Right. Supervising progress, dispersing funds in stages. So because of that extra work, they are allowed to charge an additional flat fee on top of the standard 1%.
How much additional?
If the lender actively supervises the construction progress and/or they disperse payments advances that exceed 50% of the total loan amount during the construction phase,
Okay.
they can charge up to an additional 2%.
So potentially 3% total flat charge.
In those more involved construction loan scenarios, yes, the total potential flat charge could be as high as 3%, plus the itemized fees and any discount points.
Okay, so a potential 3% flat charge in certain construction cases. What if the lender's involvement in the construction is less extensive?
Good question. If the lender does not supervise the construction or make those larger upfront payments over 50%, they are allowed to charge up to an additional 1%.
So 2% total in that case.
Exactly. In those less actively managed construction loan situations, the total potential flat charge would be 2%, again, plus the allowable itemized fees and any points.
And this applies to supplemental loans too.
Correct. These provisions for additional flat charges also apply to any supplemental loans needed for the construction project.
That's a helpful distinction for anyone considering a VA loan for new construction. So just to recap what veterans can generally pay: reasonable itemized fees, a 1% flat lender charge, or up to 3% in specific construction cases, and reasonable discount points.
That's the gist of it, yeah.
Now, let's flip the coin. What are the types of fees that veterans are specifically protected from paying? What can they not be charged?
Well, the core principle, again, is that the lender's 1% flat charge or the higher construction allowance is designed to cover those general admin costs. Right. So any attempt to bill the veteran separately for those types of services would generally be prohibited.
Let's dive into some specific examples from the handbook. What about attorney's fees, for instance? We touched on this.
Right, that's a key one. The lender is not permitted to charge the veteran borrower for their own lender's attorney's fees.
Okay.
However, and this is important to repeat, reasonable fees for the title examination and the cost of the title insurance policy are allowable itemized fees, so the veteran can pay for those specific title-related legal services.
But not for the lender's general legal work on the loan file.
Correct. And the VA also makes it clear this doesn't stop veterans from hiring their own attorney if they want to.
Right.
A veteran has every right to hire their own lawyer for the purchase, and they pay that lawyer directly. The closing documents should just show it's a separate arrangement, not a lender fee.
That's good to know, ensuring veterans can get independent counsel. What about real estate agent commissions or broker fees?
This is another big area of protection. Fees or commissions charged by a real estate agent or broker in connection with a VA loan transaction cannot be charged to or paid by the veteran who is buying the property.
Even if they hire a buyer's agent?
Correct. Even if the veteran has engaged a buyer broker.
Yeah.
The VA's rationale here, according to the handbook, is that information on properties and financing is so widely available now,
Right.
they don't think preventing veterans from paying buyer broker fees puts them at a disadvantage in the market anymore.
So in a typical VA loan purchase, who pays the agent commissions then?
Generally, the seller is the party responsible for handling the real estate agent commissions.
Okay. What about prepayment penalties? These can sometimes sting if you refinance or sell.
Yeah, the VA protects against those too. If a veteran is refinancing their existing mortgage with a new VA loan, they cannot use the proceeds from the new VA loan to pay off any prepayment penalty on the old mortgage.
Okay, can't finance the penalty.
Right. And similarly, if a veteran is purchasing a property using a VA loan, they can't be required to pay any penalties needed to clear the seller's existing liens on the property.
Got it. And there's one more category mentioned in our source. HAHFHA inspection fees for builders. What's that about?
Yes, this applies specifically in cases involving proposed new construction where the home was built under HUD supervision.
Okay.
In those cases, the cost of any required HUD or VA inspections or re-inspections must be paid by the builder or the project sponsor.
Not the veteran buyer.
Correct, not the veteran. This includes re-inspections for escrowed work and any extra inspections the VA thinks are necessary. The builder bears those costs.
Okay, so we've covered what veterans can pay and what they cannot. Now let's talk about the role of other parties, especially sellers, when it comes to fees.
Right. This is where things get a bit more flexible, but also have some important limits.
How so?
While the VA rules strictly limit what the veteran borrower can be charged, they do allow other parties, like the seller, the lender, maybe even a relative, to pay certain fees and charges on behalf of the veteran.
Including discount points.
Yes, including paying discount points to help lower the veteran's interest rate.
That sounds like it could be a really valuable way to manage upfront costs. But I see a big note here. Exception. What's the catch?
The big catch, the major exception, is the rule against excessive seller concessions.
Okay.
While sellers can contribute to the buyer's costs, the VA puts a cap on how much they can contribute in the form of concessions.
Let's clarify exactly how the VA defines a seller concession. What counts?
Good question. According to the VA guidelines, a seller concession is basically anything of value that the builder or seller adds to the deal, for which the buyer pays nothing extra, and which the seller isn't customarily expected or legally required to provide anyway.
Could you give us some concrete examples? What would be a seller concession?
Sure. Common examples would be the seller agreeing to pay the buyer's VA funding fee,
Good.
or prepaying the buyer's property taxes and homeowner's insurance for a certain period,
Right.
offering gifts like a new TV, a microwave, paying off the buyer's credit card debt or judgments.
Paying off debt. Wow.
Yeah. Or paying extra discount points to buy down the buyer's interest rate, either permanently or maybe through a temporary buy down using escrowed funds.
Those sound like pretty significant incentives. But our notes also say some things are not considered seller concessions.
That's correct. And this is really important. The payment of the buyer's normal closing costs by the seller is not counted as a seller concession.
So paying the appraisal fee, title insurance, that's okay.
If the seller pays those typical closing costs, that's generally fine and not part of the concession limit.
Okay. What else is in a concession?
Also, the payment of discount points by the seller that are considered appropriate for the market for that specific interest rate, that's also not a concession.
Could you give us an example to make that clear? The
Yeah.
points thing?
Absolutely. Let's say for a 7.5% interest rate on a VA loan right now, the market standard is that someone, buyer or seller, pays 2 discount points.
Okay.
If the seller agrees to pay those standard 2 points for the buyer, that's not a seller concession.
Right.
But if the seller offered to pay, say, 5 discount points on that same loan,
Yeah.
then the extra 3 points, the amount above the market standard 2 points, would likely be classified as a seller concession.
Okay, that distinction makes sense. It's about paying more than what's typical for the rate. So why does the VA limit these concessions? What's the concern?
The VA's primary worry is that really large concessions could be used to, well, entice veterans into buying homes they might not truly be able to afford long term.
Masking affordability issues.
Exactly. In extreme cases, huge concessions could disguise the fact that the veteran might struggle with the actual mortgage payments and homeownership costs once those initial perks wear off. It could artificially inflate the veteran's apparent ability to qualify.
So there's a specific limit then. Our notes mentioned a 4% limit.
That's the rule. Any single seller concession, or the total value of all concessions combined, cannot exceed 4% of the property's established reasonable value.
4% of the value.
Right. If it goes over 4%, it's considered excessive by the VA and unacceptable for a VA guaranteed loan.
And just to be crystal clear, that 4% limit doesn't include the seller paying the buyer's regular closing costs or normal market discount points.
Correct. Those two things, payment of normal closing costs and market-appropriate discount points, are specifically excluded from the 4% calculation. That's a critical point.
Very important distinction. Okay, now let's shift gears slightly. What happens if, for some reason, the loan doesn't actually close? What happens to the fees paid?
Yeah, that's a practical concern. For those itemized fees and charges that the borrower paid out of pocket up front, like the appraisal fee, the credit report fee, those are generally not refundable. The services were performed, the costs were incurred.
Even if the loan falls through?
Even if the loan falls through.
Okay, what about that 1% flat fee the lender might have charged?
That's different. If the lender collected that 1% flat fee from the borrower up front,
Yes.
they must refund the full amount if the loan does not ultimately close.
For any reason?
For any reason, including if the borrower simply changes their mind and decides to go with a different lender, the flat fee has to be refunded if the loan doesn't close with that lender.
That seems like a fair consumer protection.
Yeah.
Okay, let's talk now about which of these fees and charges can actually be rolled into the total loan amount itself. Financed, essentially.
Right. This really depends on the type of VA loan you're getting.
Right.
For all types of VA loans, the VA funding fee can be included in the loan amount, assuming the veteran isn't exempt.
Funding fee can always be financed. Got it.
But for regular home purchase loans or new construction loans, no other fees, charges, or discount points can be included in the loan amount.
So for a standard VA purchase, the veteran needs cash for closing costs beyond the funding fee.
Generally, yes. Those itemized fees, the flat charge, any points they need to be paid either by the veteran out of pocket or perhaps by the seller, subject to those concession rules, they can't be added to the loan balance itself on a purchase.
Okay. Where does it get more flexible? Refinancing.
Exactly. It's primarily with refinancing loans that you see more flexibility.
Like a cash-out refi.
Right. For cash-out refinancing loans, the allowable fees, charges, and any discount points can be paid from the cash proceeds the veteran gets back from the refinance.
Paid from the cash out, but not added on top of the loan amount needed to pay off the old mortgage.
Correct. The only costs that can actually increase the total new loan amount above the payoff fees and points are the VA funding fee and the cost of any financed energy efficiency improvements.
Okay. What about IRLs, those interest rate reduction refinancing loans? They're known for being streamlined.
Yep. IRLs offer the most flexibility here. With an IRRL, pretty much any of the allowable fees and charges we've discussed.
Itemized costs, flat charge, funding fee.
All of them. They can be included in the total IRRL loan amount.
And discount points.
A borrower can always pay reasonable discount points in cash on an IRRL, but there's a specific limit on financing them.
What's the limit?
A maximum of 2 discount points can be included in the loan amount for an IRRL. Any points beyond that would need to be paid in cash.
2 points max financed on an IRRL.
Got it. What about other less common types of refinancing, like refinancing a construction loan or an installment land contract?
For those other refinancing scenarios, construction loan takeout, installment contract refi, or even refinancing an assumed loan at a higher rate, the rules are a bit different again.
How so?
In those cases, any allowable fees and charges and reasonable discount points can generally be included in the new loan amount.
So more like an IRRL in that respect.
Somewhat, yes. However, there are still overall maximum loan amount limits that apply.
Okay. What are those limits? The final loan amount for these types of refinances can't exceed the lesser of 2 calculations. Calculation 1. The outstanding balance of the loan being paid off, plus the allowable fees and charges, but excluding the funding fee here, plus any discount points being financed.
Okay, balance plus costs. What's Calc 2?
calculation 2. The VAs determine reasonable value of the property, plus the VA funding fee, plus the cost of any energy efficiency improvements being financed.
So you take the lower of those two numbers as the maximum loan.
Exactly. So while you can include fees and points, the total loan might still be capped by the property value or the existing loan balance plus costs.
Okay, that gives us a really good handle on which fees can be financed depending on the loan type. Now, let's dedicate some time to the VA funding fee itself. You mentioned it a lot. What's the basic purpose of this fee?
Sure. As the VA Lender's Handbook states pretty clearly, the main purpose of the funding fee is to help defray the costs to the government of actually administering the VA home loan program.
So it helps keep the program running.
Essentially, yes. It helps make the program more financially self-sustaining for taxpayers. It's also important to remember that Congress can, and sometimes does, change these funding fee rates.
Okay. What role does the lender play in handling this funding fee? What are their responsibilities?
The lender has several key jobs here. First, they absolutely have to verify if a veteran qualifies for an exemption from paying the fee. That's step one.
Crucial.
Definitely. For veterans who aren't exempt, the lender then has to accurately calculate the correct funding fee amount based on all those factors we'll discuss.
Right.
Then, at closing, the lender collects the fee from the non-exempt borrower.
Okay.
After closing, they have to electronically send those funds to the VA, usually through a system called FFPS, the Funding Fee Payment System.
Got it.
They also need to print and keep proof that the fee was paid and submit that proof, or proof of exemption, with the final loan package they send to the VA.
And the veteran can pay it how?
Either in cash at closing or, as we discussed, it can be included in the loan proceeds financed.
Okay. And who exactly is exempt from paying this funding fee? It sounds like a pretty significant benefit.
It really is. It can save veterans thousands of dollars. The handbook lists several categories of exempt individuals.
Who's on the list?
Okay, first, veterans who are receiving VA compensation for service-connected disabilities.
That makes sense.
Also, veterans who would be entitled to receive that compensation but have elected to receive military retirement pay instead.
Okay. The retirement pay choice doesn't disqualify them.
Correct. Also, veterans who are rated eligible for compensation based on a pre-discharge exam or review, even if they aren't formally receiving payments yet.
Okay.
Veterans who are entitled to compensation but aren't getting it right now because they are still on active duty.
Right.
And finally, surviving spouses of veterans who died either in service or from a service-connected disability are also exempt. This applies whether the surviving spouse is a veteran themselves or not.
That covers a good range of situations. How does a lender actually verify if someone falls into one of these exempt categories?
They need specific documentation. Often, it's the VA Form 268937, the Verification of VA Benefits Form, which should clearly state if the borrower is exempt.
Okay.
For those choosing retirement pay over compensation, the lender usually needs to see the original VA disability rating notification and proof of their retirement income.
Right, both pieces.
For surviving spouses, their certificate of eligibility, the COE, should indicate their status and entitlement.
What if it's unclear?
The handbook advises lenders, if the status is unclear or documents conflict, consult directly with the VA Regional Loan Center for clarification. Don't guess.
Good advice. What happens if a veteran believes they are exempt, but maybe the paperwork isn't finalized before closing?
That can happen. In that situation, the lender must collect the funding fee as if the veteran is not exempt.
So they pay it initially?
Yes. But it's crucial that the lender makes a note in the loan closing package that the veteran is claiming exempt status. The VA will then review everything when they get the package. If they determine the veteran was exempt, the VA will issue a refund directly to the veteran.
What about pending disability claims?
Similar situation. If a disability claim is still pending at closing, the veteran pays the fee as non-exempt. The lender should advise the veteran to contact the VA RLC later if the claim is approved retroactively to before the closing date, as they might be eligible for a refund then.
So there are mechanisms for refunds if someone pays who shouldn't have. Now, for those who do have to pay, how is the actual dollar amount calculated?
Okay, for almost all VA loans except IRRLs, you calculate it by taking the correct percentage from the VA's funding fee tables and applying it to the total loan amount.
The total loan amount?
Yeah.
Does that include the funding fee itself if it's being financed?
Good clarification, no. If the funding fee is being paid from loan proceeds, you apply the percentage to the base loan amount before adding the funding fee.
Okay, calculate on the base loan, then add the calculated fee.
Exactly. For IRRLs, it's different. They use a specific worksheet, VA Form 268923.
Got it. IRRLs have their own form.
And there are also special calculation rules for joint loans involving non-veterans, which are detailed elsewhere in the handbook.
Okay. And how does a lender figure out which percentage to use from those tables? You mentioned factors earlier?
Right. There are several key things they look at, mostly found on the Veteran Certificate of Eligibility, or COE.
Like what?
First is the Veteran Regular Military or Reserves National Guard. The COE often notes if the higher reserve guard fee applies, and the paper might be buff-colored instead of green.
Okay, service type matters.
Second, is this the veteran's first use of their VA loan benefit or a subsequent use? The COE usually has an entitlement code, like Code 5 for first use, or shows a prior loan number if it's subsequent use.
First versus subsequent use. Got it.
Third, the type of loan itself. Purchase, construction, cash out refi, IRRL, they all have different fee structures.
All on type, okay.
And finally, for purchase loans specifically, the down payment percentage matters. There are lower fees if the veteran puts down at least 5% or at least 10%.
Down payment tiers for purchase loans.
Right. For construction loans, the veteran's equity in the property counts like a down payment for this purpose. And remember, if the purchase price is higher than the VA appraisal value, the veteran has to pay that difference in cash. It can't be financed.
That's quite a few variables determining the fee.
Yeah.
And we actually have the specific tables here from the handbook, right?
Yes, we do. Table 2 covers purchase and construction loans. Table 3 is for cash-out refinancing, and Table 4 covers IRRLs, assumptions, and manufactured home loans.
Can you give us a quick feel for the numbers on purchase loans?
Sure. For a regular military veteran using their benefit for the first time with zero down payment, the fee is currently 2.15% of the loan amount.
Okay.
If that same veteran uses it a subsequent time with zero down, the fee jumps to 3.3%.
Significant increase for subsequent use.
It is. But if they put down 5% or more, but less than 10% on a first use, the fee drops to 1.5%. If they put down 10% or more, it drops further to 1.25%.
So down payments make a big difference.
They do on purchase loans. And the rates are slightly higher across the board for Reserves National Guard members, for instance. Their zero down first use fee is 2.4%.
What about cash out refinances?
For cash out refis, the fee is generally 2.15% for first time use regular military and 3.3% for subsequent use regular military. There's no reduction for equity like there is for down payments on purchases.
Okay, simpler structure for cash out and IRRLs.
IRRLs are much lower, just BO.50% for everyone, first or subsequent use, regular military or reserves guard. Same 0.50% fee applies to loan assumptions.
0.5% for IRRLs and assumptions. And manufactured homes.
For manufactured home loans not permanently affixed, it's typically 1.00%.
Got it. And these tables mention some dates.
Yeah, the notes indicate these rates were extended through September 30, 2017, and there were some temporary lower rates way back in late 2011. So it's always vital for lenders and borrowers to check for the absolute current rates set by Congress.
Absolutely crucial to use the current tables. Okay, once the fee is calculated and collected, how and when does the lender actually get that money to the VA?
They have to send it electronically via that FFPS system we mentioned, and the deadline is within 15 calendar days of the loan closing date.
15 days. What if they're late?
If the payment is received by VA 15 or more days after closing, there's an automatic late fee penalty of 4% of the funding fee amount.
Ouch.
And if it's more than 30 days late, interest charges start accruing on top of that 4% penalty. So lenders have a strong incentive to remit promptly.
Definitely. Now, what about the flip side? If a veteran overpays the funding fee somehow, maybe an exemption was missed or a calculation error, how do they get that back?
Right, overpayments can happen. A refund is definitely due in those cases.
How does it work?
Lenders can usually process corrections that result in a refund directly through the FFPS system.
Okay.
If the veteran originally paid the funding fee in cash at closing, they'll get a direct cash refund for the overpaid amount.
Simple enough.
But if the funding fee was financed rolled into the loan proceeds, the lender can't just give the veteran cash back.
Ah, right. So what happens then?
In that case, the lender must apply the amount of the overpayment as a principal reduction on the veteran's loan balance.
Paying down the loan.
Exactly. And the lender has to provide proof to the VA that they've applied that overpayment correctly to the loan principal.
Well, this has truly been a deep dive into the complexities of VA loan borrower fees and charges.
It certainly has. It's definitely a more layered topic than it might seem at first glance, isn't it?
Absolutely. Successfully navigating these fees really requires a solid understanding of, well, what you can be asked to pay, what you're protected from paying.
And all those specific rules around the funding fee, those seller concessions, how financing works, it all fits together.
We certainly hope this detailed exploration has given you, our listener, the knowledge and hopefully the confidence you need as you go through the VA home buying or refinancing process.
Yeah, hopefully you feel more empowered to ask the right questions now. Consider the underlying purpose of all these regulations.
Right.
They're really trying to balance protecting veterans financially with making sure home ownership is accessible. It's a fine line.
It is. And maybe think about what affects these specific rules, the fee limits, the concession caps, the funding fee structure, what impact they might have on the housing market specifically for veterans.
That's a great point. It's definitely something worth mulling over and maybe digging into more based on your own situation and where you're looking to buy.